Okay, so you've got this economist, François Trahan, and he's saying two things that sound completely contradictory: apocalypse and recovery. How does that work? Well, in this explainer, we're going to dig in and unpack exactly that. So let's start with the headline grabber. He said the next 2 years are going to be apocalyptic. And look, this wasn't just some off the cuff remark. This came from a top Wall Street strategist. He wasn't talking about, a quick market dip. He was pointing to a huge long-term crisis, all fueled by government debt that he says is just unsustainable. But then, almost in the next breath, he starts talking about a recovery. So what gives? How can both possibly be true? The whole puzzle, the whole key to understanding this, comes down to looking at two very, very different timelines: what's happening right now, in the short term, versus what's coming way down the road. All right, first things first, let's get on the same page about what he means by apocalypse. He's not talking about the stock market crashing next week. No, this is a much bigger, longer-term warning. It's about this mountain of government debt and the delayed and probably painful consequences from the Fed hiking interest rates faster than they have in decades. It's a structural problem, not a cyclical one. And that brings us to the most crucial point. The market's got a pretty short attention span, right? It's really only focused on the next 12 months, maybe a little more. But these huge structural problems he's talking about, they're way, way further out. So those big issues haven't just disappeared. But for now, the market is looking at a much shorter and, frankly, a much more optimistic picture. Okay, so we've got the long-term warning in our back pocket. Now let's zoom in on what's happening today. Because right now, the economy is caught in this classic tug of war. You've got these incredibly powerful forces pulling it in completely opposite directions. On one side, you've got a ton of stuff pushing the economy forward. We're talking about massive stimulus, both from the Fed cutting rates and from government spending on things like infrastructure. That's like a shot of adrenaline straight into the system. But on the other side, you've got these really unusual headwinds. Things like new tariffs and this inflation that just won't go away, pulling everything back. And this right here perfectly illustrates the dilemma for every investor out there. For the first time in what feels like forever, two of the most reliable tools we have for predicting where the economy is going, interest rates and inflation, are telling us completely different stories. It's crazy. One is screaming recovery ahead, while the other is flashing downturn warning. So, who do you believe? Which signal is the right one? To even begin to answer that, we have to understand something really important. The old economic rules, the stuff you learned in your Econ 101 textbook, they might not apply anymore. The U.S. economy has gone through a really fundamental structural change. And at the very heart of this huge change is something called labor market tightness. It sounds technical, but it's actually pretty simple. It just means there are more jobs open than there are people looking for work to fill them. And that's a situation the U.S. really hasn't seen since way back in the late 1960s. Now, I want to be really clear about this. This isn't just a temporary blip that's going to fix itself in a few months. Nope. This is a deep structural shift. It's being driven by two massive forces. First, you have an exceptional generation, the baby boomers, who are retiring in huge numbers. And second, you've got a major shift in immigration policy that's taken more than 1.5 million workers out of the labor pool just since March. The result? A worker shortage that's likely here to stay for a while. So what happens when you have a worker shortage? Well, here's the cold, hard math. The relationship between economic growth and inflation has totally flipped on its head. For the last 30 years or so, for every 1-point jump in economic activity, prices went up by less than a point. Pretty manageable. But today, that same 1-point jump in activity leads to a 1.5-point increase in prices. So it's not just a feeling. The U.S. economy is factually more prone to inflation than it's been in a generation. This new reality, this new inflationary world, is creating a kind of economic recovery that pretty much no one investing today has ever seen before. And it has one enormous consequence for the stock market. We're talking about a great rotation, a massive shift in what's going to lead the market higher. Trahan has a name for this. He calls it an inflationary recovery. And the concept is key. In this new world, you can't just have economic growth by itself. The two are now tied together. If you get growth, you are also going to get a healthy dose of inflation. And that brings us to what might be the single most important piece of data in this whole explainer. The history here is just crystal clear. If you look at every single period over the past 50-plus years where you had two things at once, economic growth, which you can see when the ISM Manufacturing Index is over 50, and significant inflation, measured by the CPI, well, the results are stunning. In those exact conditions, value stocks have beaten growth stocks. Not most of the time, 100% of the time, every single time. So what does that actually mean for you and your portfolio? It means we could be looking at a monumental shift in market leadership. It's like a changing of the guard, away from the big tech names and the momentum stocks that have absolutely dominated everything for the past decade. Okay, so let's bring this all full circle. How do we square the short-term recovery with that long-term apocalyptic warning we started with? Let's put the two timelines together. You can almost think of this forecast like a two-act play. Act 1, happening right now and for the next year or two, is this inflationary recovery. It's a cyclical upswing, yeah, it's driven by all that stimulus, and it's going to favor a totally new group of stocks. But then there's Act 2. That's when those huge, long-term structural problems, like all that government debt, come roaring back to center stage. The stimulus is like a shot of adrenaline for sure, but it doesn't actually cure the underlying disease. So here's the big takeaway. All the signs are pointing to a massive, historically backed shift in market leadership that seems to be getting underway right now. The paradox we started with, the apocalypse versus the recovery, it all makes sense when you realize the market is focused on a cyclical recovery today, even while a much bigger structural problem is waiting for us down the road. Really, the only question left is, how long is this new inflationary era going to last?